Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit each day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is currently 6:41 a.m. Central Time, and I am recording this in preparation for the market day, January the 15th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing and trading decisions that you make. Wow, big action last night, big action yesterday. Important things are happening in the market right now. Just throw some headlines at you. Copper 6-year low. Obviously, it's not just about oil, but copper is also getting clobbered. And what this means is that falling copper also pulls bond yields lower, and then that has its own implications. The 10-year Treasury note yield, dollar TNX, going to a 1.81%. This is the lowest level since May of 2013. Not exactly a vote for confidence in our global economy. So, what does this mean for the banks? Well, the banks have falling rates, and that hurts them. And certainly, we've already seen some of the early bank earnings reports, not very pretty. Then you have stock volatility rising, and we'll talk about our volatility metrics in a few moments in a little bit more detail. But certainly, it is pretty obvious that we have a lot of range and a lot more volatility than we had much of 2014. The VIX is testing a major resistance line. If you go back to late 2008, draw a trend line using your weeklies, you will see that those upturns in 2010, 2011, they all come across a nice little trend line, and we are smack up against that right now. So what happens if we break this long-term, multi-year VIX trend line? What does that mean for our volatility in the days and weeks to come? So let's dive into those subjects. We've got a lot to cover today, and we've had some upgrades to our hedge risk level yesterday. So many things on the docket for us today. In the overnight action, huge overnight action. It was well up and then came crashing down across all the broad market indices in the overnight. So I haven't done the research to figure out which report it was, but bottom line, it was a pretty significant overnight, and we are clearly weaker coming into the open today. We do have a whole bunch of macroeconomic reports for ourselves today in the U.S. market, so certainly that will have influence as well. Also note crude oil down 1.18%, and crude oil had some big moves yesterday and continues to have significant volatility. Gold up 1.52%. So what is that saying in terms of a run for safety? Look at this. China up 3.55% as of the time that I cut this. Hong Kong up 1%. Japan up 1.86%. But then Germany a little bit up. Obviously, not doing the same thing that the U.S. market was doing in the overnight. And the United Kingdom, though, was the odd player out in our group here, down 0.41%. In terms of economic reports for today, unemployment claims, Empire State Manufacturing, Core PPI, Philly Fed Manufacturing, all on slate for today. If you're a nat gas trader, you've got your storage inventory report today. And then tomorrow, a number of reports, including one that often captures people, the University of Michigan Sentiment Report, which is released during the trading day. You've got that one tomorrow, along with pre-market reports from CPI. So a lot on the table in the next couple days that could certainly provide volatility and direction to the marketplace. In terms of volatility, couple things to note here. The short-term VIX has popped up over 20, well up over 20 now, 21.23. And we continue to see the historical IV percentile start to climb again. Even though these last 2 days we've not had greater than a 1 standard deviation move on most of the broad indexes, this is actually not the full story. We've had wide moves these days, but we've ended up with candles. For example, yesterday on the SPX, it's a hammer. Is it the bottom? Well, it would need confirmation to be painting a bottom, and as at this moment it would not appear that we're going to get that confirmation. So while it was a possible reversal signal as of the close yesterday, a hammer, generally you look for confirmation, and that does not appear to be happening. So significant increase in volatility in the last 2 weeks continues, and expect more with the open today. In terms of our market timing, we've changed our trend phase. We're now going to call this phase 5, the in short term break of support. Yesterday we did put in a lower low on a intraday basis, not a closing basis, and that was important, but still clearly we're showing the ability to have the in short term a break of our horizontal support. We have in a market portfolio trader posture, we now have uptrend under pressure. Active trader market posture, no new short-term or intermediate-term bullish trades is our current call. Note that we continue to see this flip-flopping around the center point. So this is really probably best called neutral, but this combined with the other factors has caused us to elevate our hedge risk opinion. We have moved it up to a level 1. We'll get more detail on that in just a second. We are oversold, and at some point we are going to see a bounce on this. So we do have, while we're in current weakness, and we're not saying that first thing this morning go bullish, but you should be looking for signs of bottoming patterns and an ability and opportunity to go and put on some highly aggressive but bullish trades. The long-term forecasts, are at least in terms of an intermediate term I should say, the next 2 weeks is still slightly bullish. Market forecasts, again, borderline. We continue to rotate around this 50 line. We are bearish one day, bullish the next day. It's flip-flopping back and forth, and ultimately quite neutral. But we are at a hedge warning status elevation up to level 1. So this is our yellow light, or hit the brakes. Uptrend under pressure. We have had some volatility signals flashing. Our cross relationship status has flashed a market in decline. We have had a VIX spike. Obviously we're up over an 18. Our VIX, if you look at the daily, we have had a squeeze that has fired long. And then, of course, on our intermediate trends, the SPX has a lower high and a lower low on an intraday basis. The RUT, a higher low and lower high. And the NDX, 2 lower highs and a double bottom set of lows. So really, really very difficult to be much of a confident bull when you're looking at these most recent swings across these important markets. We have had distribution days. We added another SPY distribution day yesterday, so we now have our count at 3 on the SPY and 1 distribution day in our window for NASDAQ. So those continue to tick along. Remember, we had 6 distribution days in the SPDR in December. And the recount started when we changed the posture, but when the posture went back to uptrend under pressure, we started counting again, and you know, we quickly have accumulated a number of distribution days already. So while it for a brief moment looked promising that we had put in some bottoming action and we were going to go bullish, it failed very quickly and has rolled back over. VIX obviously is rolling up, not conducive to option income strategies at this time. You're above your window. Notice that, and we don't have enough time today, but we'll do this in shortly, but we'll talk a little bit more about the characteristics of phase 5. I will roll through this slowly so that if you like to take a look at this at your leisure, you can just hit pause. But there's a number of characteristics that we look at in these different buckets as to, which phase are we in. What kind of patterns do you see? What kind of candles do you see? Obviously, we're not in full-fledged bear market by any means yet, but we're certainly seeing some cause for corrections. And let's very quickly roll this up. In terms of our second sector market posture, only utilities and telecommunications were green in terms of percent change yesterday, so not promising, and they were not terribly strong. I suppose you could say utilities pretty good day, up 0.32%. But in terms of the sector market postures, and I think I flip-flopped those tables in the order, but our market posture is very mixed, very, very, very mixed. Healthcare and utilities being the two places that are probably, in quotes, the safest. But remember, in a bear market, everything can go down. It's just how much down do they go. In terms of our industry groups, top 5, retail, railroads, healthcare, internet, and transportation are our current top 5, and it's been that way for some time with that group. So enough for today. Important changes though: hedge risk level 1. So start to take particular care to protect your capital, and also in terms of initiation of new positions, while pullbacks give you opportunities to enter, you have to also measure how aggressive to be, what position size to use, and when that is the best opportunity to go in. Good luck, good trading. Thank you for being part of our Falcon Global community. As always, certainly we appreciate you liking us and following us on social media. Email support@falconglobaltraders.com. Disclaimers. Hit the pause button if you need some more time to read those disclaimers. And as always, we greatly appreciate you and our Falcon Global Trading community. Thank you.